Question. The price at which demand and supply are equal is known as options A. Market price, option B. Favorable price, option C. BEP, option D. Equilibrium price. Answer option D. Equilibrium price. Question. The Sale of Goods Act came into force in the year option A 1934, option B 1956, option C 1872, option D none of these. Sale of Goods Act വന്നത് 1st July 1930 ആണ്. അപ്പോൾ ആൻസർ ഓപ്ഷൻ ഡി none of these. Question. Excess of actual sales over break-even sales is known as option A. Real sales, option B. Margin of safety, option C. True sales, option D. Angle of incidence. Answer option B. Margin of safety. Question. The degree of responsiveness of a commodity to the changes in the price of its substitutes and complementary goods is known as option A. Price elasticity of demand, option B. Cross elasticity of demand, option C. Income elasticity of demand, option D. None of these. Answer option B. Cross elasticity of demand. When the demand for a product is tied to the purchase of some parent product, the demand is called option A. Autonomous demand, option B. Company demand, option C. Derived demand, option D. Individual demand. Answer option C. Derived demand. Question. When only a few sellers of a product are found in the market, it is called option A. Monopoly, option B. Duopoly, option C. Oligopoly, option D. None of these. Answer option C. Oligopoly. Question. The concept of marketing mix was developed by options A. Philip Kotler, option B. W.J. Stanton, option C. Clark and Clark, option D. N.H. Borden. Answer option D. N.H. Borden. The registration of a trademark shall be for a period of option A 5 years, option B 20 years, option C 40 years, option D 10 years. Answer option D 10 years.